The US economy continues to be resilient. The job market continues to add jobs. At the same time, we're also seeing further progress in lowering inflation in the US, especially when you look at the core PCE measure, which is what the Fed focuses on. So we're having this pretty Goldilocks scenario for the Fed, where we're having slower inflation at the same time as the economy remains resilient. And we're seeing these upgrades in the outlook for the US economy. So what this means for the Fed is that it gives it an opportunity to be more dovish and to signal that it will probably cut interest rates this year in response to lower inflation and sort of achieve this soft landing that it has been arguing for throughout 2023.
So to clarify, you are expecting a further pause this week?
So with respect to the January meeting, I think the FOMC is not going to change interest rates, so it will be another pause. And so the focus will be on the FOMC statement that gets released immediately at 2 p.m. EST, as well as what is it the Fed going to signal about the March meeting and beyond.
The market has been at an all-time high on the expectation rate cuts are coming. Is the Fed going to be wary of licensing further exuberance at this point?
I think the Fed will be very cautious not to signal too strongly that it's going to cut interest rates in March. I think where the market pricing right now is, it's kind of a sweet spot for the Fed. They want to maintain full optionality. To be clear, I think there's been enough progress in lowering inflation that the Fed will cut interest rates this year and probably as soon as March. But from the Fed's perspective, there is nothing to be gained from giving the markets more certainty at this point because we have two more inflation reports and two more employment reports before the March meeting. A lot could change in the data between now and then. And we also know that they would have learned the lessons from the Q1 data in 2023 when employment data surprised to the upside, and also inflation revisions meant that the progress was not as assured as they had expected. So I think the Fed will be cautious. It will not want to give the market more ammunition to price even more cuts for this year, and it will want to keep full optionality about the March meeting.
But you expect rate cuts could begin as early as March. How many are you expecting this year?
So I think it remains an open question. I think the Fed will cut interest rates because nominal rates will become apparent that nominal rates and real rates are high when inflation decelerates even further. Market pricing right now is about 5 cuts for 2024. I think they are underestimating just how quickly this Fed will move based on progress on inflation and also based on the pace of employment growth slowing. I expect that employment growth will slow this year, not to recessionary levels, but to levels that will make the Fed concerned about its dual mandate. So we'll have progress on inflation, we'll have slower employment growth, and I think this combination will lead the Fed to probably cut more than the market is pricing right now.
How many more?
It could be 1 or 2 more. It could be 6 or 7 cuts this year.
Finally, are you expecting changes in the pace of quantitative tightening, and why or why not?
So I think we know from the minutes of the FOMC December meeting and also from a recent speech from Lori Logan, who is the president of the Dallas Fed, that those discussions have started within the Federal Reserve System and the FOMC. There is uncertainty about when that might start. The way I'm thinking about it right now is that the Fed will probably start to reduce the pace of QT at some point, probably towards the middle of this year. Or they could start reducing the pace of QT or stopping QT altogether if it becomes evident that we are no longer operating in an environment of ample reserves. Again, a lot of uncertainty about the exact timing and the exact way in which this will QT will stop. I think the sequencing will be such that they'll want to start with rate cuts and then tweaks to the balance sheet.
Blerina, Uruci, thank you.